Welcome, everybody. Welcome to a presentation at Open Banking Week. My name is Nick Cabrera. I'm co-founder of the Open Future World here in the UK, bringing together the best people and ideas from the world of open banking and open finance. Now, with me today, I have two individuals who are going to be discussing with me some of the most common myths and misconceptions people may have about open banking. So without further ado, I'd like to introduce two very well-known people, Hugh Davies and Chris Michael, who will introduce themselves. Chris, perhaps you may want to start off first.
Sure, thanks, Nick. So my name's Chris Michael. I'm the CEO and co-founder of Ozone. We are a specialist API platform that really is designed to help banks and financial institutions deliver great open banking APIs.
Yeah, and I'm Hugh. One of the other co-founders at Ozone, and prior to Ozone, Chris and I also worked at the UK's open banking implementation entity, where I was leading the development of the ecosystem, and Chris was leading the development of all of the open banking technical standards.
Fantastic, thank you. So we got two people who've seen it all, heard almost everything. And I think from what we've got to discuss, we probably will hopefully cover quite a lot of some of the misconceptions and maybe some of the myths that people may have about open banking. So, Chris and Hugh, let's tackle the first myth that I think we've all heard quite a number of times, is that customers don't want to use open banking. So who would like to go first? Hugh?
Yeah, I'm happy to take that one. To be honest, I think the best place to start is actually with the metrics. So open banking has been a thing in the UK and Europe for a number of years now, following the PSD2 regulation and the implementation of open banking in the UK. And actually, the usage data has grown strongly and exponentially for the last 2 or 3 years. So one of the measures we always looked at was the number of API calls that were happening each month. Has continued to grow. I think the last month that the OBIE reported, there were 800 million API calls. That's a huge amount. Now that's across just the 9 biggest banks in the UK. So if you think about all of the API calls that will be happening across Europe, it's a significant number. Now it's kind of a technical number. So what are some of the other things to look at? Well, one is the number of new third parties and new fintechs that have developed to connect to banks' APIs and build propositions. And there are, I think, about 500 regulated third parties in Europe at the moment. And that number just grows month on month on month. So there's clearly a lot happening because there are a lot of businesses that are connecting to these bank APIs. And then users are using it. And we see a huge range of different use cases out there. There's the much more obvious and common ones, like customers seeing all their accounts in one place so they can get better financial management and make sure they get to the end of the month with more savings, or paying off debts, or managing their money more effectively. Businesses using open banking to feed data into their accounting platforms. It's being used really heavily as well to help those loan onboarding journeys, so customers don't have to provide copies of statements. And it allows financial institutions to make better decisions based on much more data. But there's a whole load of other use cases as well, whether that's around driving financial inclusion, or new ways for SMEs to improve invoice payments. There's a huge range of use cases. So I think the metrics suggest it is really being used and customers are wanting to use it. One point to make, though, is actually a lot of customers probably don't necessarily need to understand what it is and how it's working, as long as it's clear and in the context of the use case what they need to do and why they should trust it and feel safe. So for example, if I'm applying for a loan and through clicking a button and providing secure consent, I can make the loan process easier and make it more likely that I'll be approved. That's a really good use case. The customer doesn't have to understand all of the technical mechanics and the infrastructure that's happening below. Just like most customers don't really understand the details of how card networks work and payment rails work. So I think customers do want to use it. They don't necessarily need to understand all of the technicalities, but there is a piece for the industry to help customers understand what it is and why it's safe without trying to over-explain it. So yeah, I think there's plenty of proof that customers not only do want to use it, but they really are using it.
And Hugh, just a question, because culturally, of course, what's been happening in Europe has been accelerating, and it's growing and it's fast, and people are familiar with using online banking. But cross-culturally, we're talking about emerging markets in South America, for example. Do you see any cultural resistance from what you've seen and heard so far?
Again, we look at markets like Brazil, where there's young population, really high mobile usage. There's some digital banks that have grown at really rapid rates, but also some societal challenges such as financial inclusion, with sort of 40 to 50 million adults outside of the traditional banking sector. Personally, I would say the opportunity is greater because of some of the characteristics. Now, there will always be some cultural nuances in terms of how to communicate and what's the right way to educate customers. But personally, I look at different markets around the world. I look at Latin America and Brazil. And I think the opportunity actually is that much greater.
Yeah, I tend to agree. Okay, next myth, Chris. This one I think should try and address this. This the whole issue about risk around fraud, particularly with unauthorized payments and data being leaked. In Europe and in America, there have been stories about data loss and hacking attempts, data being shared without consent. This is one myth, is about customers' data is being exposed without consent and risk. How would you answer that?
Yeah, so I mean, there is a risk, and I think it's important to point out that open banking, whilst this new model of APIs has only been around now for a few years as a thing, if you like, with open banking. Open banking itself has been around for well over 10 years, and that's been in a sort of old model whereby customers would give their online banking credentials, their username and password, to a third party. The third party would impersonate the customer and screen scrape and access the customer's account to get the data, to make a payment, pretty much to do whatever the customer could do. Now, that old model inherently was much more risky, because obviously sharing credentials isn't a good thing generally anyway, and it's widely recognized as being a very big risk, but also because those third parties could be anyone. There wasn't a kind of regulatory framework to say which customers could offer services using open banking. So what this new model does, and it's been kind of driven initially by in the UK and Europe with the CMA order and the Payment Service Directive, it puts in place a number of things that actually protect the customer much more than they were protected before. There's this concept of a trust framework and requiring secure communications so that only regulated, authorized firms can access a customer's account. And then the second element is strong customer authentication, making sure that customers have got secure credentials when it comes to being able to log in to access their account, and that those same secure credentials and that same secure method of strong customer authentication is used to authorize to give access to a third party. So doing that based on, and in the UK, the standard is based on the OpenIDs Foundation's FAPI standard or protocol, and that stands for Financial Grade API Protocol. This is something that's now the basis of the standards in Brazil and pretty much many other markets around the world that are starting to adopt open banking. That puts in place a very high bar to make sure that the customer's data is actually protected. And then also just having a good, strong standard that dictates a data model and how consent is captured and used and done in a way that's both secure and also transparent to the customer, so that the customer is giving very detailed, fine-grained consent to what the third party can access, rather than saying the third party can access everything. They might only be able to access the last 3 months of transactions and for one-time usage, for example, or just to make a payment of a particular amount one time to one person. So those sort of fine-grained consent parameters are embedded in the standard, and that puts an awful lot of additional protections in place for the customer. PSD2 also in the UK and Europe puts in place a liability model as well. Yes, there are some gaps or things that other people want to change about it, and what we're seeing is other markets who are adopting open banking are now looking at building on top of what's been done in the UK and Europe. But all of this provides better transparency and much better security and protection for customers.
Does that, and in terms of enabling this level of sense of safety and security, is this a collaborative effort that needs to be put into place with the regulators, the financial institutions, and the fintechs? Do you see an emergence of an alignment of being able to work together to create an environment where people feel safe, particularly in emerging markets where this is all coming into play, that this can happen?
Yeah, well, I think the difference is that PSD2 in Europe didn't actually mandate or define any standards. So you had this construct of there were several standards bodies across Europe developing standards, and the regulators weren't insisting on a particular standard. What we're seeing in most other markets that are following open banking, whether that's Australia, Brazil, the Middle East, what we're seeing now is that the regulators are actually defining the standard. And so the regulations and the standard are more tightly knit. And I think that effectively what that means is that in other markets now, all of the banks are having to follow the standard. Now that has effectively become the status quo in the UK because of the CMA order, and the CMA 9 were actually required to implement a common standard, and then all the other banks followed. We're seeing now that's starting to be the case across Europe. Europe's probably playing still a bit of catch up there. But as I said, in other markets, emerging markets, there is a much tighter definition of exactly what standard the banks have to follow and how tightly they have to follow it. And I think overall that's a good thing. Okay,
yeah. And also you're talking about banks, and this is another one of these myths we've all heard, is the fear, is the belief that banks are going to be marginalized by all these new third parties, these fintechs, these services that are popping out of nowhere. What do you think is the truth behind that?
Yeah, it's a good question. I remember 4 years or so ago, that was a big part of the conversation, how there was going to be all this innovation and banks were going to be disintermediated and become a dumb pipe, and yeah, that was a very common conversation. And I talked a moment ago about the number of third parties and the amount of innovation that's happening. I think it's making banks have to perhaps work harder to deliver a good customer experience than they might have done in the past. If I think about a bank's mobile app or a website, actually, if you banked with different banks, a lot of them look the same. And there's lots of applications now that are just making money management a lot more intuitive, bringing in gamification, different kind of ways of presenting customers' financial position, and it's driving a lot more innovation, a lot more focus on user experience. So I think it is requiring banks to work a bit harder to do the same things really, really well. But I absolutely don't see this as being at the expense of banks and resulting in this mass disintermediation, which was one of the concerns. If anything, I actually think banks are some of the primary beneficiaries of this whole movement towards open banking. If you look at again, markets like the UK, a lot of the big banks have have included new financial management tools and the ability to see your broader portfolio within their apps and within their websites. They're really leveraging open banking access to help those lending journeys that I talked about a moment ago. Chris, we were talking to one of the biggest banks in the UK last week, I think, and they said, yeah, the biggest third parties that call their APIs are the other big banks. So it's creating a competitive environment, but absolutely not at the expense of banks. I think what we're seeing is banks are using this as an opportunity to kind of upgrade and do a bit more in their existing digital channels, so they can help their customers see more of their portfolio and really try and get that customer primacy. So that bank app is the only place you need to go. But at the same time, they're using the potential to build partnerships with all of these other fintechs as a route to innovate more quickly in more creative ways and at a lower cost. Again, we were talking to one of the big, a very big global bank a couple of years ago, and they said historically it would have taken us a year and a half and multiple millions to introduce a new proposition in our mobile app. Now with open banking, we can partner up with one of these fintechs and get new propositions out much more quickly than we ever could on our own. So they're using it. I think that the banks, rather than being marginalized and cut out, I think they're using it, one, to do far more in their own channels, but two, to partner much more quickly, much more cheaply, and much more effectively to get more propositions out to their customers than they ever could have done on their own. So yeah, I think that myth has proven to be incorrect, and banks are really starting to leverage the opportunity now.
So in essence, really, if we're talking about, I mean, clearly banks in Europe and other parts of the world where open banking is becoming established, they're aware of the opportunities and they're embracing it, and they're building teams that help them enable all these applications and connections to happen. But of course, there are going to be parts of the world in which banks, in particularly countries where there is no framework for open banking yet, who are vaguely aware of the potential opportunities in open banking. So is there a message out for them in terms of what is it they need to start thinking about even before they start building teams and operations that will enable open banking to happen in their countries?
Well, if you look around the world, I mean, it's been driven in a number of markets by regulation. So the UK, Europe, Brazil, Mexico, Bahrain in the Middle East. But actually in quite a few markets, it's happening in advance of regulation or being followed by a loose framework. So again, a lot of the markets in Asia Pacific, actually it's driven more by market conditions first, with the regulators putting a sort of a loose structure around it, or a playbook around it. Again, the US, there's been this move from screen scraping, as Chris was talking about, more towards API-based access. So I think it's inevitable around the world, whether it's driven by regulation or market forces. It's just the way it plays out looks a little different. Where it's driven by regulation, as Chris was saying, you get much more of a drive towards standards and a common implementation approach, which is a really good thing. Whereas in some of the commercial markets, it's perhaps focused around a smaller number of use cases and on a bank by bank basis, but with much more of the commercial incentives at the heart of it. So yeah, I think it's inevitable whichever way it's driven.
Yeah, I think I tend to agree. Okay, Chris, another one, and this is the one I've heard quite a lot as well, and it's to do with money and cost, and that it's actually quite costly to implement open banking. So what do you say about that?
Yeah, I mean, I think it's no secret that the big banks in the UK have said this a few times, that it costs them an awful lot to deliver open banking, and it costs them a lot more than they thought. And I think there are a number of reasons for that. Firstly, they tried to build it all from scratch themselves. I think secondly, I think the standards were still being developed anyway. and so they were trying to build when the goalpost was still moving to some extent. But I think, ultimately, big organizations, banks, for example, quite often find technology-driven change is an expensive thing. So I think this kind of, whilst it can be expensive, I think, what we've seen many of the banks doing is actually using it as a way to reinvest in their technology estate, to modernize some of their technology estate. So, it's not just about open banking, it's about modernizing the entire digital platform. And that's obviously a good thing because that offers benefits as well. But, first and foremost, I would say, what we have now is more mature standards that are more common across the world. And we've got specialist platforms like our own software platform, Ozone. We built this to do all the hard work, and take all the pain out of building open banking APIs, so it can just slot on top of a bank's existing technology. And platforms like Ozone significantly reduce the time and the cost and the pain and complexity of delivering open banking, or for that matter, open finance. So, whilst it might have cost the big banks quite a lot initially, there isn't really certainly in my view, there isn't a valid reason why it should be an expensive or complex thing for banks moving forwards.
Yeah. Okay. Yeah. I think you're right. I think it's always isn't it that famous curve where early adopters tend to sometimes come across the highest costs in technology, and as it becomes more common, then the cost base starts to drive down. However, though, even though the costs are coming down, another one of these myths we've all heard is that it's extremely difficult to make any money out of this. Turning out revenue, generating revenue. So, Hugh, I mean, where's the commercial upside?
So I spent most of my career working in the big banks, and it's very hard to get anything done if you can't show a positive business case. Well, frankly, you either need a really positive business case, or there needs to be a real kind of regulatory mandate to do something. Now, I actually think some of the things we've talked about already give a hint to how a positive business case can be driven around open banking, and I think it really can. So, actually, Chris's answer to the last question, I think it starts with do it in a cost-efficient way. So, spending an absolute fortune trying to build everything from scratch and reinvent the wheel is going to make it much harder to generate a return. The environment is more mature now. There are platforms like ours and that can help banks deliver this much more quickly, effectively, and at a lower cost. So banks can focus their resource on how do they actually then drive that positive return. And I think that comes in a couple of different ways. So one of the things we've talked about already is doing more for less. So historically, the product innovation cycle for a bank is long and expensive. But through exposing APIs and working with some of these new fintechs, whether these are PFM specialists, lending specialists, payment specialists, banks can plug on these partner propositions with far less cost than it previously took to get a new proposition to market. So far less cost, much quicker, and actually test things in the market more effectively, so they're not burning huge budgets on new proposition development. But it's also, again, delivering really good and high-performing APIs is a route for banks to get products out there in places that they might have struggled to in the past. So banks traditionally have distributed their products mostly through their own channels and their own brands, and they don't always appeal to every customer. If you just look at how Google distribute Google Maps through great APIs, Google Maps is now pervasive in so many other apps and propositions. And again, if banks deliver great APIs around lending, payments, identity, these sorts of things, they can get embedded in other places, marketplaces, commerce experiences, invoicing platforms that allow banks' lending products or onboarding to be in the right place when the customer needs it. So again, I think it can help banks get to more customers in more ways. But one of the other things I think we're about to see is premium APIs start to take hold. So banks doing more than just the regulatory requirements. So whether that's APIs like variable recurring payments, so banks can offer much better and more intelligent payment experiences that can get embedded in e-commerce checkouts, invoicing platforms, and banks can make those available on a more commercial basis, or onboarding tools using, banks have invested a huge amount in validating customers' identity, and customers trust banks and third parties trust banks. So actually helping customers onboard in a much more efficient way with validated identity information and attributes. There's a great use case there for customer, for bank, and for third party. And I think we'll see these things start to really scale as well. So I think through managing the cost of how it's done, using it to do things faster, better, cheaper, and get more products out there, and then creating new revenue streams, I think there's a potential for a very positive business case.
And I think also it's all about creativity, isn't it? This new world we're in is essentially all about being creative with new applications and ideas that enables financial services to offer services to those who have not had access to new ways of managing their money and other services. Fantastic. Well, unfortunately, we're running out of time, everybody. This has been a fantastic conversation with our two Mythbusters, Hugh and Chris from Ozone API. My name again is Nick Cabrera. My pleasure hosting this particular conversation, and very, very pleased to see Hugh and Chris tell us a bit about some of the most common myths they've also come across in their past. Gentlemen, thank you very much for your time.
Thanks, Nick.
Thank you very much, Nick.